Coming up on Market to Market, runners hit the final hurdle on a much-needed infusion of disaster cash, removing recourse for farmers and ranchers at the packing house door. And a community college creates a holiday staple in the classroom. Those stories and market analysis with Tomm Pfitzenmaier next.
Beneficiaries of fund buying.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. This is the Friday, December 22 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Paul Yeager. The final days of holiday shopping are speeding towards a conclusion. Click and order is being replaced by last-minute brick and mortar purchases as the home delivery window rapidly closes. All this conspicuous consumption moved the needle higher on the nation's gross domestic product. Third quarter GDP hit 3.2%, which is expected to push the annual rate to 2.3%. The effect of the larger number of purchases was visible in the Creighton University Rural Main Street Index. The economic snapshot of Middle America did have an increase, but remains below growth neutral. And as consumers wrap up the holiday season, Congress was making its final sprint to pass legislation before heading out for the holiday recess. Lawmaker luggage was close at hand, and there was last-minute wrangling over the most comprehensive tax overhaul since 1986 that will add $1.5 trillion to the national debt, a stay on shuttering the government, and a battle to give a much-needed infusion of cash to assist those hit by severe weather. John Torpy has the details.
With a tax reform win for the GOP earlier this week, congressional Republicans moved quickly to pass two more bills in the last days before the holiday recess. The first keeps the government running until January 19th. The second adds additional money for disaster relief. On Monday, GOP leaders unveiled an $81 billion aid package for victims of wildfires in the West and a hat trick of hurricanes that battered Gulf Coast states and the Caribbean. The additional financial aid brings total disaster relief to $130 billion for 2017. Some of the funds have been earmarked for fighting wildfires that have scorched almost 10 million acres in the western United States over the past year. A small percentage of the relief package is stamped for farm disasters, which will help hurricane recovery efforts and assist states like Florida to battle citrus greening. The bacteria has wiped out large portions of the Sunshine State's signature crop. In Texas, Hurricane Harvey cost $200 million in agricultural losses, half of which belongs solely to the cotton industry. Market to Market will have more in-depth coverage of Hurricane Harvey recovery efforts in Texas on an upcoming program. The disaster relief bill included items that upset some members of the U.S. Congress and various conservative groups. A provision allowing cotton growers inclusion in the price loss coverage program was seen by some as a handout. Another issue bringing criticism centered on lifting the annual limit on livestock insurance programs for dairy producers. The $81 billion disaster aid measure is double what President Trump requested last month.
On this vote, the yeas are 251, the nays are 169. The bill is passed.
While passage in the House of Representatives was a quick bipartisan vote, the measure never made it out of the gate in the Senate, as concerns from both sides of the aisle stopped the aid package before it could make it to the floor. For Market to Market, I'm John Torpy.
The herbicide glyphosate got a reprieve from the EPA this week. A draft of its final report revealed the active ingredient in the popular weed killer Roundup is not likely to be carcinogenic. The EPA will take comments in early 2018. Another of the federal government's alphabet soup of agencies, the Grain Inspectors, Packers and Stockyards Administration, or GIPSA, pulled back on a rule adopted late in the Obama era. Colleen Bradford-Krantz reports.
USDA is being sued over its decision to scuttle rule changes that would have granted livestock producers leeway in challenging meat packers and processors over what some consider unfair practices. Changes to the Packers and Stockyards Act, proposed in December 2016, were known as the Farmer Fair Practices Rules. If enacted, they would have allowed farmers to show that they had individually faced a competitive disadvantage due to the actions of a packer or other company, rather than having to show an effect on the entire industry. The debate has become particularly important to the swine and poultry industries, as many producers tend to operate under contracts with some of the nation's largest pork and chicken companies. The lawsuit, filed by Lincoln, Nebraska-based Organization for Competitive Markets, a Nebraska beef producer, and Alabama poultry farmers, asks the courts to force USDA to reinstate the rules. USDA withdrew the proposed changes in October, saying they are inconsistent with past court decisions. The pending lawsuit, filed last week in the 8th Circuit Court of Appeals in St. Louis, claims those past decisions prove there should be a clarifying rule to protect farmers from predatory trade practices. In addition, the petition argues that the 2008 Farm Bill required the agency to put in place portions of the proposed rule, including guidelines to help USDA determine what might be considered an unfair practice. For Market to Market, I'm Colleen Bradford-Krantz.
According to the American Christmas Tree Association, nearly 80% of U.S. households, almost 94 million homes, have a Christmas tree this season. A holiday symbol almost as identifiable as the poinsettia. In 2016, the venerable plant was worth $140 million to domestic producers. There is more than meets the eye to growing this Yuletide staple, and one group of college students takes on the challenge every year. The Christmas tree gets the lights and songs, but not everyone cuts down a live one and puts that in their home. The one embracing the colors of Christmas is the Mexican transplant, the poinsettia. Brilliant bracts of green and red, white or pink. The plant has more than 100 variations.
Blooms naturally around Christmas time, which made it a good fit for the holidays. So it blooms based on day length, so we don't have to manipulate it too much to get it to flower. But it's also kind of the traditional Christmas colors.
Those colors have evolved as the plant has grown in popularity. More than 30 million are sold each year, according to USDA, almost 1/4 of all flowering potted plants purchased, to rack up more than $144 million in sales. The poinsettia first came to the United States in 1825, but only set roots in our lexicon during the 1960s. The lobster flower, or flame leaf flower as it's also called, is found almost anywhere from churches to homes. New varieties emerge every year as hybrids take hold, and science works most of the time.
There'll be a slight difference. So maybe the bract color is darker, or you'll have 1,000 white plants and one is pink. So a lot of them are just natural mutations where we did some cross-pollinating to get one variety and then it's just naturally mutated. That's very common in plants.
Randall Voss is the horticulture program chair at Des Moines Area Community College in Ankeny, Iowa. Annually, he leads a class that grows the poinsettia from sprig to sale.
Our main goal with the poinsettias is to give the students a hands-on class. We don't have tests in this class, it's all how do your plants turn out.
The customers are usually faculty or staff on campus. Voss, who has a background in commercial horticulture, helps students understand the demands of the end user, extending the lesson as growing the best plant root to bract.
We test the pH of the media, the salt content of the media, which lets us know if we're fertilizing too much or not. Every week they have to graph the height of their poinsettias because we follow a growth curve to see if we're in line with the height. On some of these varieties, we did not, stay on top of the heights. They're too tall, and that's part of the grading requirement.
Macklin Briggs is one of those students getting his hands dirty in class. He says timing is key, as the poinsettia performs better in drier conditions to help the modified leaves form fully.
There's a science to growing all plants, but with these, you want to get spacing right so they grow the right height, and so they don't get weak stem and all the brackets are fully formed.
And that knowledge Briggs plans to use in his horticulture career.
Whatever you learn from growing a poinsettia, you're able to take that and then apply it to other plants.
Couple of notes about the poinsettia. The leaves are not poisonous individually. You would need to consume more than 500 leaves to have any harmful effect, according to a study from Ohio State University. The same study reveals pets dining on a milky leaf could experience nausea or intestinal irritation. California is the nation's top poinsettia producing state in the U.S. September's shorter sunlit days signal to the poinsettia it is time to change colors or bloom. The internal clock interprets more dark than daylight as the cue to initiate the flower. Greenhouses take precautions to block out any light as to not disturb the cycle. The window for error is small and can be delicate, even for seasoned professionals.
The tricky thing about poinsettia is you get one chance every year. There's only one poinsettia crop, so even if a grower's been working for 10 years in a greenhouse, they've only grown 10 poinsettia crops. Most other greenhouse crops are growing them year-round, so let's say in the spring you might get 5 shots at growing petunias.
And Voss's hands-on approach stresses the customer's expectation: uniformity.
The customer doesn't know that this plant naturally grows taller, that one naturally grows shorter. It's up to the grower to make everything uniform, so you look down the bench, no matter what variety there is, they're all the exact same height, because that's what the customer wants. They might put 2 of these plants together, they want them the same height, and that's kind of what makes or breaks you.
Next, the market-to-market report.
Traders spent the week leading up to the Christmas holiday fighting lagging exports and forecasts of good growing weather in South America. For the week, March wheat gained 7 cents, while the nearby corn contract put last week's nickel back on the board. The nearby soybean contract was unable to fend off news of lower exports and good growing conditions in Argentina, as the January soybean contract fell 18 cents. March meal lost $3.90 per ton. March cotton stretched higher, another $1.89 per hundredweight. Over in the dairy parlor, January Class 3 milk future soured 45 cents. February's cattle on feed report added to, or that was on Friday anyway, added to an already bearish week in the livestock complex. The February cattle contract sank $2.45 and nearby feeders plunged $6.20. The February lean hog contract put on $1.45. The U.S. dollar index plummeted 54 points. February crude oil jumped up $1.14 per barrel. COMEX gold poured on $21.30 per ounce. And the Goldman Sachs commodity index ticked 9 points higher to close at $428.55. Here now to lend us his insight on these and other trends is one of our regular market analysts, Tomm Pfitzenmaier. And in case you want to go over things again, you can download or listen to our market analysis and Market Plus podcasts online anytime at iptv.org/MTOM. Tom, the official formal hello. Hello.
Hello. Thanks, Paul.
All right, let's talk wheat right out of the bat, because both wheat and corn, is it fair to say it's just good that you were able to break almost even, just a tiny bit up for the week with those? Let's start with wheat.
I think that'd be a positive for sure. You know, wheat's probably, March wheat closed, I think, around 425, 427. That's probably about in the middle of the trading range of where it's going to, if you kind of get things going in a little short covering rally or whatever at the end of the year, you might see it bump up to 450. but there's an equal chance we could move back down toward the $4.10 to $4 range. So I would guess it's going to be range bound. Technically, it turned higher this week. A lot of the indicators turned up. We did become quite oversold. So I guess a little carry through bounce next week really wouldn't be a big surprise. Still a lot of wheat around. The Russians had a heck of a good wheat crop. Plus the weather's been pretty decent, so they were able to move it out. Australian wheat improved some. There is talk about dry weather in the U.S. and reduced wheat planting and all that, but that's probably a ways down the road as a factor.
Well, that's what I was going to ask, is about that long-term weather. This week, the U.S. Drought Monitor, areas in drought, 56.74%. That's our highest since October of 2015. That extends a heck of a long way in that wheat belt in the United States.
Right.
Long-term, deferred contract, what's that going to do for impacting that?
I don't think it's going to do much of anything for a while. Like I said, it might do something in March or April if this lingers and we don't get rains, at the end of the winter. Then it might become a factor. In the meantime, I don't think it's something. It's nice to talk about, but I don't think it means a whole lot.
Getting even and maybe putting 6 cents on like we did this week, is it time to make any sales?
Yeah, like I said, you get up in that, March wheat up in that 435 to 450 range.
Yeah.
I think you need to scale up, unloading some wheat.
Okay. Corn-wise, again, feeling good just to be even. Still not a lot of news that's helpful there. Exports are slow, off 40% year to year. I think it bumped back maybe towards...
Well, that's kind of a two-part story.
Yeah,
export
what's going on there?
Sales have been pretty decent.
Yeah.
It's export shipments that we're just not moving it through the port. So I think that's the reason why the USDA didn't make any change in their export estimate on the because everybody was like, well, shipments are down, they've got to make an adjustment. But I think they're kind of holding off to see, we had delayed planting on the soybeans down in Brazil. There's some people that believe that that's going to end up cutting the safrinha crop, which could throw some demand to us in the first and second quarter next year. So I think the USDA's held off adjusting their export number downward, and I think that's appropriate. We're offering the cheapest corn in the world, so right. Exports should be pretty decent going into the quarter, and I expect we'll start to move it.
Well, let's talk a little bit about that deferred contract. Dan in Geneseo, Illinois, one of our Twitter questions. We always thank you. You can reach us at Market to Market, or you can find us on Facebook at IPTV Market. And Dan in Geneseo has the question for you, Tom. He says, I've got a decent basis locked in for July corn. Should I sell the carry or wait for a spring rally to finalize my price?
Sell the carry. The carry goes away. Sitting and waiting for the carry doesn't help you because carry goes away as time goes on. Now, I'm not saying we couldn't have a 10-cent bounce here or something at the end of the year, first of next year. And so you probably want to do some scale-up selling, watch the technicals if they start to roll back over, because they turned higher in corn also this week. If they start to roll up, then I think you make sales and you sell the July carry. I think waiting for a spring rally is... I wouldn't do it.
Yeah, time to make
right.
some.
Well, the best time to sell is when somebody wants to buy it, and that's on a rally here.
Well, and ethanol concerns. I know you watch that heavily in your newsletter each week, every day, and that's not exactly been friendly to help sales.
It's been terrible. I mean, we've just been building stocks, and it continues to drive the price of ethanol down. Ethanol producers went from really good margins to negative margins, and I suppose they're going to continue to operate, I suppose, as long as they can cover their marginal costs. But they're not going to be inclined to pay up for corn to do that with. So we're going to. I think Dan was wise to get his basis locked in.
Yeah.
That part of his move was quite good, and more people should be looking at that. But if the ethanol producers start to have negative margins, they're not going to pay off, and you're not going to get the basis improvement, especially when everybody knows the farmer's sitting on this huge crop right. that at some point is going to have to move. Now, maybe you don't want to move it now, and maybe you don't want to have to move it at all, but at some point it's going to have to go, and everybody knows it.
I got you started, sorry. And now we'll talk soybeans. It's almost a similar
you
story.
wound up the doll.
I turned it. Soybeans, you're down 50 cents since that high here just a couple of weeks ago. Not much positive there either in a bad week.
Well, and you touched on in the intro, there was a lot of concern about dry weather in Argentina, and then that weather forecast kind of changed. El Nino, or La Nina, excuse me, was building, and then it sort of stabilized, and now is it building, is it not building? And then the other factor that nobody wanted to talk about that all of a sudden popped up in the last week or two is that despite all this, the Brazilian crops have been quite good.
Right.
They practically have no problems. You know, the USDA estimated that they would produce 108 million metric tons. There are privates that are using a number as high as 114. So, you know, that kind of offsets some of that concern about Argentina. Now, that's not to say some of that might not pop up again after the first of the year, and they could dry out, and we could put some money back on the soybean market. But you know, you want to use that as right. Then on top of that, you got the potential for the U.S. farmer to plant 91 million bushels of beans with an average yield. That's a lot of beans. And in the meantime, our exports have been falling off just a little bit and are probably a bit overstated.
Do you buy the conspiracy theory that the price is lower a little bit? They're trying to push that price lower on beans, so there's not as many bean acres or acres put into beans?
I don't buy any conspiracy theories whatsoever. I'm not sure how farmers are going to make. Every fall I hear that the farmers in such bad shape. They're going to plant beans because they're cheap, and nobody's going to plant corn next year. And then all of a sudden, spring rolls around and corn gets planted. So I'm assuming we're going to be pretty close to 91 million on both of them.
Okay. All right. Let's move into the livestock complex. Cattle on feed late in the day. Here on Friday before we tape, Tom. Cattle up 8%, and we got 11.5 million head. That's 8% above.
They were looking for placements to be up about 105.6, I think, and they came in up on 114. So I mean that was a huge placement number, and that's what sort of tanked the cattle market on Friday, and we'll probably see some carry-through selling on that on Tuesday when we reopen. Demand's been quite good for beef. Exports been really good, but we got some numbers coming at us. We got cheap corn, so that has tended to, that number of days on feed has gone up, which tends to mean more weight.
Right.
So I don't think the cattle market's going to totally fall out of bed here, but there's some pressure to come. The one thing you talked about in the intro that is interesting to me is how much the feeder market dropped. You'd think with cheap corn and relatively high fat prices, the feeder market would be stronger than it is, and the fact that it isn't is a little bit concerning.
It's off 620 on the week. That's 4.2%, and then feeders, again, they were 14% above last year.
Right, that's what I'm saying.
I mean, just like you said, back up with those numbers. It's a problem. I mean,
the feedlots are getting full here.
Do you sell before it goes any lower?
I think you sell recovery. I mean, it wasn't like it was limit down or anything Friday, so you don't want to get too carried away. But it's certainly any bounces you'd want to be using as selling opportunities on the beef side.
All right, we're marketing well there, but let's talk about hogs. They were one of the positive. $1.45 up on the week, 2%. What's going on there?
That one was, I'll be quite honest with you, was confounding to me because every single number in that hog and pig report Friday morning was negative. I mean, every one of them was at the top end or above the top end. The intentions number, the farrowing number, the pigs on feed, every category, and yet we rallied in hogs. So I don't know whether it was because the market was a little thin on Friday, and sometimes you have packers that are short as a hedge that are buying those back, and if nobody else is there, it gives the market a lift. I don't know what happened, but I'd be suspect of that rally that we had on Friday, and if you get much more out of it, I'd be a seller of hogs. Yeah, because there's more hogs coming at us.
We won't have trading on Monday, so come Tuesday morning, you're going to maybe want to try to pull the trigger if you need to, is what you're saying.
And exports on pork's been really good, but it hasn't been good enough to quite justify the kind of rally we saw this week. I don't think.
All right, well, before we go, I have to ask you one more question about the dollar. The dollar dropped a little bit this week, and that's something we're always continuing to watch. Off 53 points. We need that thing to go lower to make us continue to look attractive. Do you see it going lower?
Well, you've got this interest rate differential disadvantage that because the Fed has signaled that they're going to continue to raise rates. The ECB intends to keep interest rates low. The Bank of Japan does as well. So the dollar, to me, it looks like it's going to continue to be under pressure here.
Okay.
So I don't see that getting away from us on the upside. And a cheaper dollar is good for our commodities. So that's a positive if you're looking for one.
All right, Tom. I appreciate it. Thank you, Tomm Pfitzenmaier.
Thanks, Paul.
That wraps up the broadcast portion of Market to Market. However, we will keep the conversation going, including answering more of your questions during Market Plus, available in podcast and video form on our website. One note before we go. Mike Pearson resigned on Monday after a little more than 5 years at the Market to Market table. All of us here at Market to Market want to thank Mike and wish him well in the future. That'll do it for this week. Thank you so much for watching. I'm Paul Yeager. Merry Christmas and have a great holiday week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.